Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the vote by the UK Parliament on Prime Minister Theresa May's Brexit deal, the ECB rate decision, and US yield curve inversion. But before that, I'll run down the biggest events in the economic calendar. On Monday, there's UK industrial production, UK trade balance, and UK GDP. On Tuesday, there's UK unemployment and average earnings, German ZEW, and US PPI. On Wednesday, it's China foreign direct investment, US CPI, and EIA crude oil inventories. On Thursday, it's the Swiss National Bank and European Central Bank policy decisions. And finally, on Friday, it's the Japanese Tankan report, China retail sales, China industrial production, Eurozone composite PMI, and US retail sales. Moving on to the top corporate results to watch this week. Air France and Lufthansa report results on Monday. Carpetright gives a half-year update, while American Eagle Outfitters release its Q3 earnings on Tuesday. Superdry, Dixon's Carphone, John Wood, Ashton Group and Sports Direct all release results on Wednesday. Then Adobe and Costco report third quarter earnings on Thursday, with no large companies of note reporting on Friday. Okay, on to the Brexit Parliament vote. So the British pound against the dollar is down at 127. There's a lot of worry about this particular event. As a reminder, the Theresa May government has struck a deal with the EU for divorce proceedings, so our way of exiting the European Union. The second stage of Brexit is to work out the future relationship between the two, but that can only happen once this divorce part is agreed upon, and it doesn't look like Parliament really wants to agree on it, and so hence the British pound has been falling. I think it's fair to say that if the deal does pass, that's probably sterling positive, and we push up significantly above 127 and probably quite soon thereafter above 1.3 on sterling dollar. What seems more likely at the moment is that the deal doesn't pass. And there are a few second order situations to consider if the deal doesn't pass. Obviously, some more or less sterling negative. But I think probably the most straightforward situation is if the deal gets rejected, how do the Conservative Party react to Theresa May's status as leader? There could be a no confidence vote. We came close to that a couple of weeks ago. A no confidence vote and a new leader coming in would initially be sterling negative. Depending on who the replacement is and their views upon the EU referendum, that would affect whether those sterling losses continue. I would suggest if it becomes a more hardline Brexiteer, Boris Johnson maybe, even Jacob Rees-Mogg, that would probably be more sterling negative. Someone who's a bit more balanced could actually stabilise sterling from there. But obviously, then even if that leadership situation gets resolved, then you have to decide what to do next with the deal. And still, we could muddle through without a solution and end up with a no-deal Brexit. That would be typically, most people expect that to be fairly negative for the British pound, down through that 127 barrier. We could also come up with a bit of a fuddle, which would be the Norway solution. That would involve us staying in the EMEA, and so that basically means we're still tied to Europe and still tied to free movement of goods and still free movement of people, and that's not really what people voted for in Brexit. So even though that may be good from a kind of market stability standpoint, it wouldn't be good politically, and again that could lead to some future political problems, particularly with the Conservative Party, maybe even lead to a Corbyn government. Specifically with the Parliament defeat, that could lead to a confidence motion. So that could be if the Labour Party cite that if there's a massive defeat for this, there's obviously a lack of confidence in the government. That could lead to another general election. Theresa May could somehow avoid any of these confidence votes by maybe reversing course and calling for a second referendum, saying, okay, let's just take this to the people again then. Do they want my deal or maybe just no deal? There's a possibility that Article 50 gets revoked. I personally don't think so. There was a democratic vote, whether you like it or not. I think there would be a lot of people upset on both sides of the viewpoint if the government just went against the vote. So there's so many different political situations here. It does seem like the most likely scenario is that the vote doesn't pass. So that's to some degree priced in, but I think there would still have to be some sterling negativity and some more sterling losses were that to happen. Probably the biggest opportunity would be actually if somehow Theresa May sneaks this through. That's actually unexpected at this point. So there would be a distinct rally and probably up through 130 for the British pound. So watch out for that possibility. Okay, for enough of Brexit, there's too much to talk about there, but we can talk about the ECB. So basically, it's quite a big event, but it's been sort of usurped by other things like the trade war. But net bond buying by the ECB is going to end in December. We think that will happen as scheduled. Some people are wondering whether the ECB sort of continue some sort of stimulus because the economy's been slowing. But really, I think at this stage, yes, the economy has slowed, and this is something we've been saying for a long time, which has not necessarily been in line with central bank actions, but really we don't warrant emergency measures anymore. So even though the economy does look weak, for example, Germany even contracted in Q3, interest rates shouldn't be zero and the central bank shouldn't be buying all this debt. It's not necessarily for the current economic environment. And it's, you start talking about side effects of asset bubbles and things if you continue to do so. So we think the ECB does stop, but that's largely expected. The ECB will continue to reinvest the money, so the balance sheet won't actually be reduced for a while. And the political consideration actually against any new stimulus anytime soon is that by introducing stimulus, in essence keeping rates low, Italy wants to borrow a lot more, and this would actually help them do that if the ECB were to continue to do that. So that by introducing more stimulus, the ECB would almost become politicized by doing so. So the next topic, just to finish this video off on, is yield curve inversion. This is something that got markets pretty worried last week. Just as a reminder, yield curve inversion is when shorter dated securities yield more than longer dated securities. So the normal environment obviously is that having an investment over time is risky. So you get compensated more by earning higher interest rates for holding a longer dated investment or a longer dated bond in this case. And the inverted scenario is where something bad looks like it's coming up in the short term. So you're actually asking to be paid more interest to compensate you for that short-term risk than you are something in the future. And that typically is a precursor to a recession. Typically, the big signal of a recession is when the 2 years invert over the 10 years. In this case, it's the 3 years and the 5 years. So not necessarily the full-on signal. Typically, the way this works is that 1 or 2 years later, there's a recession. Stock market will often predict that recession 12 to 18 months before it happens. We don't think this necessarily is a recession indicator, but obviously we've been in a massive economic boom. It's the second longest economic boom in history in the US, big stock market rally. So it would make sense that just sheerly because of time, this thing ends quite soon. And so actually the indicator makes sense from that perspective. But there are some technical things going on here. Short covering in the 5-year securities, for example, there were massive bets that yields were going to start breaking out because and this 30-year bull market for bonds would end. But in fact, that doesn't seem to be the case there. That bet has been unwinding. So when they've been covering the shorts, the 5-year securities have been rallying, the yields have been coming back lower again, and obviously that's slightly affected how they relatively perform against the 2-year bonds in this case, the 3 years rather. So what's the conclusion here from this inversion? We think probably it's just symbolic of a changing mood. It's not just buy the dip every time mentality anymore. This has been a long running market with low volatility. Volatility is going to be on the rise, and that makes sense because we haven't got the same level of central bank stimulus that we had anymore. So more volatility in markets means it's less of a buy and hold environment, more of a trading environment, which is obviously great for traders, not so great for long-term investors. So on that note, thank you very much for watching. Good luck for trading this week, and if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.